right, everyone, I guess we can get started. So welcome to this month's webinar of innovation, productivity growth, and new challenges in the digital area. So we're really glad to have Fama-Miller here to present the work with Ye Li, who's also here, on money creation in decentralized finance, a dynamic model of stablecoin and crypto shadow banking. Let me just briefly tell you about Simon. He's a research fellow at the University Chicago Booth School, and then will join HEC Paris as an assistant professor of finance in 2022. His research focuses on fintech, corporate finance, and entrepreneurial finance. Simon has published in the top journals in finance. He has published 3 papers on the Journal of Financial Economics and presented research at the leading academic conferences. And together here, we also have our discussant, Professor Yubo Chen. He's the senior associate dean and also professor of at the School of Economics and Management at Tsinghua University. He's also the director of Center for Internet Development and Governance at the same institute. Okay, so after this brief introduction, it's a great pleasure to listen to the research by Simon Ye. Simon, please take it away.
Thanks everyone for being here, and thanks for attending this webinar. So like I think Ye was about to present this paper and I jumped in because he caught a cold. So like, please, I'm sorry if like some of the logistics do not work out because I'm currently traveling. So today I'm presenting money creation in decentralized finance, a dynamic model of stable coins and crypto shadow banking. And Ye probably in the audience is also happy to answer some questions you might have during the talk and might put into the chat. From 2008 onwards, the rise of cryptocurrencies and Bitcoin in particular heralded a new era of digital payments. However, while these cryptocurrencies were initially intended to serve as a means of payment or store of value, their inherently high price volatility clearly limits these functions. A more recent phenomenon related to cryptocurrencies and blockchain technology is the rise of decentralized finance. As the name already suggests, decentralized finance is essentially finance without an intermediary and offers blockchain-based alternatives to brokerage, banking, lending, exchanges, and so on. Crucially, most of these decentralized finance activities demand a blockchain-based safe asset that can serve as a medium of exchange. Stablecoins rise to meet this demand for a blockchain-based safe asset. The upper 2 panels of this graph should give you an idea about the recent growth we have witnessed in the decentralized finance sector. The left panel depicts a measure of decentralized lending activity, and the right panel depicts a measure of decentralized exchange usage, both of which are integral parts of the decentralized finance ecosystem. Interestingly, simultaneous to the growth of and expansion of the decentralized finance sector, we have seen stablecoins grow at similar pace. The lower panel depicts the market value of major stablecoins, which has grown exponentially over the last few years. By now, stablecoins have reached a market cap of about 180 billion US dollar. The trend indicates further growth. So what are these stablecoins? Stablecoins are cryptocurrencies that are designed to minimize price volatility and that are pegged to a reference unit, typically the US dollar. Most stablecoins are issued by specialized stablecoin providers, which do not conduct any other business, such as MakerDAO or Tether. However, in addition to that, we also see well-established networks of payment providers venture into stablecoin issuance too, such as JP Morgan issuing JP Morgan coin or PayPal to consider to launch PayPal coin. The crucial question in this context is, how do stablecoins maintain price stability or the peg to the US dollar? The most successful and thus least volatile stablecoins predominantly rely on reserves or collateral backing the stablecoin, allowing for open market operations to stabilize the price. For instance, when the stablecoin price drops below the peg, the issuer can use the reserves or the collateral to buy back stablecoins to drive back the price to the peg. In many cases, the reserves backing the stablecoins are risky. For instance, in the example of Tether, the largest stablecoin, the reserves consist mainly of commercial papers of unknown quality, and Tether is only backed to a minor extent by cash or cash equivalent. In addition to that, we also have so-called algorithmic stablecoins, which claim to employ alternative or innovative stability mechanisms. But in many cases, these stability mechanisms simply mean less reserves or riskier reserves. So in fact, algorithmic stablecoins are in principle often not so much different to the reserve-based counterparts. Given the growing importance of stablecoins, we as financial economists need a framework that helps us think about stablecoins and in particular helps us analyze the stability or fragility of certain stablecoin initiatives, especially if you want to talk about regulation. In this paper, we provide such a framework. With our model, we also rationalize many of the strategies that stablecoin issuers employ in practice, and in particular, we provide guidance for an optimal implementation for practitioners. These strategies include open market operations, the dynamic requirement of user collateral, transactional stability fees, a price band within which the stablecoin price can float, or the issuance of so-called governance tokens that function as the stablecoin issuer's equity units. In this context, our framework can also be used for valuation of these governance tokens, which is actually what practitioners are interested in. We will put particular emphasis to analyze the stablecoin initiatives led by large platforms or payment providers such as PayPal. And in this context, we consider that the stablecoin issuer collects transaction data brought up by stablecoin usage. And importantly, we ask whether this is a good thing or whether privacy requirements should preclude such data collection. And finally, we use our model to assess regulatory proposals for stablecoins. At this point, let me give some brief overview of our framework. We consider a dynamic model in which stablecoins are issued by a financially constrained stablecoin issuer, whom we refer to as the platform. The stablecoin issuer or the platform is financially constrained in the sense that raising financing by issuing equity is costly or not even possible. Stablecoins offer a convenience yield and are therefore bought by stablecoin users. Stablecoin users are risk averse to reflect that they value price stability, or simply that price stability is a desirable feature of any transaction medium or store of value. The platform maximizes its equity value, and in order to do so, it dynamically manages reserve assets, the transactional user fees, and the stablecoin supply, possibly via the open market operations and buying and selling stablecoins to the users. We showed that in equilibrium, the platform strategies, and in particular, the stability or fragility of the stablecoin, are fully characterized by the platform's excess reserve C, which is the difference between the platform reserve asset value in dollars and the value of outstanding stable coins. In particular, when the excess reserves are large, the platform or the stablecoin undergoes a virtuous cycle. In these circumstances, there is no price volatility, transaction fees are low, and the stablecoin price is indeed at its peg. The stability of the stablecoin boosts the demand for the stablecoin and therefore the revenues of the stablecoin issuer, which allows the issuer to further grow its reserves, exerts upward pressure on the excess reserve C, and improves the stability, and so on and so on. By contrast, when the excess reserves C are low, there is a vicious cycle. Under these circumstances, there is price volatility, transaction fees are high, and the stablecoin price drops below the peg. Under these circumstances, the instability depresses stablecoin demand and the issuer's revenues, further pushing downward the issuer's reserves and further exacerbating instability and reducing the demand for the stablecoin. And in particular, when the excess reserves drop sufficiently low, the platform is liquidated, for instance, because there's a run on the stablecoins, a concern that features prominently in policy debates. In particular, we characterize an instability trap. Stability can last for a very long time, but once the stablecoin becomes unstable and the price dips below the peg, the recovery back to the fixed exchange rate regime or the stability regime is slow or not even possible. Finally, we use our results to discuss the regulation of stablecoins. The rise of stablecoins has attracted the attention of regulators and policymakers, especially in the US. To give an example of that, on the 1st of November 2021, the US Treasury released a report on stablecoins, also discussing potential regulation. After that, on the 14th of December 2021, the US Senate held a hearing on the risks and benefits of DeFi, i.e. Decentralized Finance, and stablecoins. Our paper contributes to this policy debate and in particular recommends certain ways of regulating stablecoins. We find that motivated from the traditional banking literature, a reserve or capital requirement for the issuer is beneficial in that it improves welfare and the stability of the stablecoin. More interestingly, restricting the riskiness of the reserve assets has actually the opposite effect than a reserve or capital requirement. In particular, we find a volatility paradox. If the regulator constrains the issuer to hold safer assets, the issuer endogenously responds by reducing the reserve assets, which actually can make the stablecoin more fragile and unstable. And finally, we show that widely discussed privacy requirements that actually constrain the issuer to collect transaction data have even an unintended benefit of stabilizing the stablecoin. At this point, let me go directly into the model. The model is set up in continuous time and there's an infinite horizon. There's a continuum of users indexed by I who have a discount rate R and buy stablecoins to transact with each other. Stablecoins, which we call also tokens, have an equilibrium price PT, which evolves according to the law of motion in 1, with endogenous price drift P and endogenous price volatility sigma P. So importantly, we do not start out by constraining or setting sigma P to 0. It will rather be an optimality outcome that the issuer maintains a stable price so as to boost the demand for the stablecoin. In our model, there is some uncertainty governed by some Brownian reserve shocks. So we will discuss these shocks later, but these shocks could capture that the reserve assets backing the stablecoin are risky, or also that there are operational shocks or demand uncertainty. So these shocks can be interpreted broadly. The users can trade the stablecoin without frictions at price PT among themselves, but possibly also with the platform. Not that when the platform essentially trades against the users and the users sell the tokens to the platform, then this is akin to the users redeeming tokens from the platform. The platform controls the token supply ST, and in particular this token supply expands when the platform issues or mints new tokens, and this token supply contracts when the platform buys back tokens from its users. The users do some optimization over the optimal token holdings, UIT, in dollars. In particular, the users derive some utility from holding tokens. And this utility consists of a standard convenience yield, capturing the transactional benefits to holding tokens. And the utility users derive from holding tokens also increases with potential expected token returns, but decreases with the opportunity cost of holding tokens, the interest rate R, a fee FT, the platform levies to the users, and in particular with token price, risk, or volatility, sigma P. In essence, the users are risk averse, and so they have a preference for price stability, which simply captures that, a stablecoin's purpose is to be stable, and stability is actually a desirable feature of any transaction medium. And the fact that like users can actually also expect token returns captures some arbitrage, essentially some speculative motive. When the price of the stablecoin dips below the peg, then there's positive returns if you expect the price to return to the peg, and actually motivates you to buy the stablecoin because you would like to earn a profit. Doing the user optimization, which we do not do explicitly here, we obtain then some stablecoin demand in equation 3. The stablecoin demand essentially increases with a constant A, and decreases with the opportunity cost of holding tokens R, with the fees the platform charges FT, and in particular decreases with token price volatility. And last, we impose some upper bound on the stablecoin demand for technical purposes, which could simply capture that the number of transactions the platform can handle is constrained. The stablecoins are backed by reserves which have value in dollars MT. And these reserve assets, MT, they grow with the interest earnings at rate R. They grow with the proceeds from issuing new tokens, which is the second term. And note that the second term can be negative if the platform buys back tokens. And these platform reserves also grow with the fee revenues, fall with the dividend payouts to the platform owners, and last are exposed to a shock which scales with overall stablecoin demand. And the shock can capture that reserves are risky, as in the case of Tether, but can alternatively also capture some operational shocks, which could render a stablecoin risky, even if it were backed by fully dollars or reserve or safe assets. What does the platform do? Well, the platform maximizes the equity value of its owners. In particular, the platform maximizes the expected discounted payoff value of its dividend payouts, DDIV. We assume that these dividend payouts, DDIV, must be positive, reflecting that the platform owners are protected by limited liability and that issuing new equity is not possible. And this is an assumption we relax at a later section of the paper, but not in this talk. And last, the platform owners are more impatient than the users, a regularity assumption simply assuring us a well-behaved solution. In an equilibrium, the market for the stablecoin or the tokens has to clear, which is simply that the demand for stablecoins NT must equal the supply for stablecoins in dollars ST times PT, the right-hand side. To solve the model, we have now to keep track of several state variables. In particular, we have to keep track of the platform reserve assets MT and the value of outstanding stablecoins, or referred differently, put differently, the platform liabilities ST times PT. In this context, we define the value of platform excess reserves as the difference between MT, the platform assets, reserve assets, and the platform liabilities ST times PT. And why do we do that? Well, we showed that CT is the only state variable in a Markov equilibrium. And this excess reserve CT has a nice interpretation, with CT positive corresponding to over-collateralization. What is over-collateralization? If the platform excess reserves are positive, the platform can essentially defend the exchange rate if all users were to run and to sell off their stablecoin holdings. In particular, there cannot be a run destabilizing the stablecoin. This changes under collateralization when the excess reserves CT are negative. Under these circumstances, if all users were to sell their stablecoin or possibly to redeem their stablecoins, the stablecoin price would drop. In particular, with under collateralization, the platform is exposed to a run and cannot always defend its exchange rate. Such a possibility of a run causing the failure of the stablecoin is not only a theoretical possibility, we have actually observed this in the June last year with the so-called Iron Finance bank run. To capture the potential risks, costs, or hazards of a run on the stablecoin causing failure, we assume that the platform is essentially liquidated once the excess reserves dip negative at C is equal to 0. And this can be interpreted that the stablecoin users essentially run on the stablecoin once they see that there's not sufficient collateralization. We solved the model, and in particular, the platform becomes risk averse or becomes worried that it is actually liquidated due to a run. In particular, when the excess reserves are sufficiently low, it cannot maintain stability anymore, and the stablecoin price is floating within a targeted price band. This leads to two regions. When the excess reserves C are large, the platform or the stablecoin is in the stability region, so there's no price volatility. Once negative shocks to the reserve assets drive down C, then there is an instability arises and stablecoin volatility emerges. In particular, the stablecoin is unstable when the excess reserves are low. To graphically illustrate this, the equilibrium looks as follows. Price volatility, there is no price volatility and the stablecoin is stable when the excess reserves are sufficiently large and in particular to the right of this dashed red line. Once, however, the reserves fall below the dashed red line, price volatility rises, and in particular, the stablecoin drops below its peg. As I said, the users value price stability, so we expect the demand to increase with the platform reserves, because more reserves correspond to more price stability. In particular, we see this on this graph. The excess reserves are low and the stablecoin is unstable. Demand for the stablecoin is depressed. Once the stablecoin becomes stable and the excess reserves grow further, then the demand for the stablecoin increases too. So in particular, demand for the stablecoin increases with the collateralization level. This panel also shows again the demand for the stablecoin on panel A. In the middle, the token price, and then on the right-hand side, the token supply. Let us start with the panel B, the token price. In particular, when the stablecoin is stable, again, to the right of the dashed red line, the token price is indeed at its peg, which we normalize to $1. However, once again the negative shocks to the stablecoin issuer drive down the reserves, then the price of the stablecoin dips below the peg, causing price instability. The model also gives guidance for the optimal open market operations the stablecoin issuer should conduct to manage the token supply and to stabilize token price. In particular, the right panel C shows you the token supply the stablecoin issuer implements in optimum as a function of C. What does our model essentially predict in terms of optimal open market operations? Well, this token supply is constant in C for sufficiently large levels of C. So when the platform is sufficiently collateralized, there are sufficient reserves, the model says essentially that there's not much scope for open market operations. The price of the stablecoin is stable regardless. This changes when the stablecoin issuer's reserves drop below a certain threshold. Under these circumstances, for intermediate levels of C, a negative shock to the stablecoin issuer's reserves causes downward pressure on the stablecoin price. The stablecoin issuer, however, counteracts this downward pressure by buying back the stablecoins upon a negative shock. In particular, in this region, the stablecoin supply increases with the excess reserve C. Interestingly, once the issuer's reserve C fall below a critical threshold denoted by a dashed red line, the stablecoin issuer actually acts by the opposite. If there's a negative shock, the price drops downward, but the stablecoin issuer no more stabilizes the price by buying back stablecoins. It acts the opposite and actually issues more stablecoins in the hope of being able to replenish its reserves. How do the model dynamics look? The following simulation graphs give you an idea about the model dynamics. Of particular interest is panel B, which shows you a price path of the token price, of a price path of the token. What we can see is that the stablecoin price is indeed stable and sits at the peg for most of the time, in this case until period 5. But at this point, instability kicks in and price volatility rises. Then the token price drops below the peg, and it takes quite a long time for it to recover again back to the peg. In particular, the stability regime lasts for a very long time, but once instability occurs, the token price is debased and price volatility rises. The recovery back to the stability regime is slow. We formalize this thought by also calculating the stationary density of excess reserves. As we can see, this distribution of states is bimodal, with a large mass of probability near the payout boundary in the stability regime and a large mass of probability near zero where stablecoin price volatility is high and the stablecoin is actually fragile or unstable. That is, we document a so-called instability trap. Stablecoin is stable for most of the time, but once price volatility rises and the price falls below the peg, the recovery back to the fixed exchange rate regime is slow. At this point, let me quickly talk about regulation before I conclude. We consider several types of regulation, and I will just highlight now two. The first one is a standard capital requirement, which, motivated by a banking literature, requires the issuer to hold a minimal level of reserves, or in terms of our model, excess reserves. We look then, what does such a capital requirement have effects in terms of price stability, in terms of platform value, in terms of user welfare? Clearly, a capital requirement imposes regulatory costs on the issuer, decreasing platform value. So the platform value essentially decreases with the strictness of the capital requirement. On the other hand, the capital requirement stabilizes the price of the stablecoin, therefore improves user welfare. What we show in the paper is essentially that the optimal capital requirement is non-zero. So in optimum, we have actually a capital requirement that maximizes total welfare. The interesting bit is that actually restricting the riskiness of the reserve assets has a different effect than imposing a capital requirement. How do we study such restriction of the riskiness of reserves? Where we consider some small extension in which the reserve assets evolve according to this equation. And we have here an additional term that reserve assets earn return at rate mu hat, but are exposed to additional volatility sigma hat. In this case, we consider that mu hat and sigma hat are linked by this equation, which simply means that the Sharpe ratio omega is constant along the comparative statics and sigma hat we consider. Particularly, I would like to draw your attention to the dotted red line, which is the case of omega is equal to 0. In this case, when sigma hat increases, the stablecoin reserves just become more risky, but do not yield more returns. We then consider two measures of price stability. The first is average token price volatility in panel C, and the second one is the probability that the stablecoin sits at its peg of $1, panel B. As sigma hat increases, the stablecoin becomes riskier, and surprisingly, the probability of maintaining the peg increases, while the average token price volatility decreases with sigma hat. What do we find? We find a so-called volatility paradox. If the regulator restricts the issuer to hold less risky reserves, the issuer actually responds to this regulation by reducing its collateralization level, which can make the stablecoin more fragile and unstable. At this point, let me conclude. In this paper, we develop a dynamic model of stablecoins and crypto shadow banking. We show that actually the stablecoin, despite over-collateralization, can be fragile and unstable. We find an instability trap. Stability lasts for most of the time, but once debasement occurs and price volatility rises, the recovery back to the instability regime is slow. Our model rationalizes many of the stability mechanisms we observe in practice, such as the requirement of user collateral, the dynamic management of platform reserves by open market operations, stability, transaction fees that are set in a dynamic manner, and also, not mentioned in this talk, the issuance of so-called governance tokens that function as the issuer's equity units. In this context, our model can be used to value these governance tokens. More importantly, the model can also be used to assess regulatory proposals. We find that a capital requirement, if well designed, can improve welfare or the stability of the stablecoin. By contrast, restricting the riskiness of the reserve assets has the opposite effect. There is a volatility paradox. If the regulator restricts the riskiness of the reserves, the stablecoin can actually become more fragile. And finally, we show that privacy requirements that limit that the stablecoin issuer collects transaction data from stablecoin usage has actually the unintended benefit of stabilizing the stablecoin. Thank you very much for your attention, and I'm looking forward to a nice discussion by Yubo and also to questions from the audience. Thanks everyone for attending.
Thank you, Simon. Maybe we'll have Yubo, please. Feel free to share your slides, and you have also 25 minutes.
Okay. First, thank you, Bernard, for inviting me to be the discussant for this excellent paper. I really enjoy reading the paper, and Ye and Simon did a great job. And actually, I'm a marketing professor. This is the first time I'm serving as a discussant for finance paper. Okay, so I do see some kind of similarity in two streams of the literatures, but certainly a lot of the modeling framework is totally new for me. I cannot claim I'm an expert on that. So, and I actually following on Simon's presentation, I'd like to talk about probably the last part of the paper, which is on the regulations on platforms. That's actually my also area on the. So briefly summarize the paper. And so the paper did an excellent job to provide a theoretical framework and provide a very nice insights on stablecoins. So I really like the instability traps and bimodal equilibriums. And also the paper really provide a comprehensive analysis on stablecoins regulations. So several different regimes, and they find out actually the capital requirement is the best. And also in the end, they did a nice analysis on a lot of the current probably essential basic issues regarding the digital platform regulations related to stablecoin, of course, in this context. So I'd like to probably dig more into on this field on the regulations on digital platforms. So so I can, because due to limitations, Simon, probably didn't have time to go through that. So I can just briefly edit on this part. So we all know, in the last several years, global regulation agencies, they all start to impose strong regulations on digital platforms. And there's one interesting, probably a central issue in this area is, how you, as a regulatory agency, how you deal with, the emerging trend on basically digital platforms entering financial markets. So like we all familiar with examples like Alibaba, Ant Financial Service, and Facebook's Libra, etc. I mean, of course, Tencent, WeChat, etc. So whether it's in Silicon Valley or in China, the digital platforms, they all start to go to the financial service market. And then, of course, in the last several years, probably starting from China, we all heard about, so the government have a strong regulations on basically the digital platform, their behaviors in financial markets. Before, of course, it's pretty open. So specifically like Ant Financial Service issues. And so I think the question is, should digital platforms be treated as a tech company or as a traditional financial service player, right? So that's probably the central issues. And in this paper, I think the paper nicely touched the issue. In the end of the paper, the last section is, so should a digital platform actually, be regulated? I think a more general question for probably is be allowed to issue stable coins. Okay, so we all know, in China, that's the question is no, right? But then, of course, in the rest of the world, depending on the market, even in the States, I talk about in a second about the Facebook's issue, right? So, so how to regulate, right? So if so, how to regulate? So I think that I really like the analysis in the paper, so they provide a very nice model so we can, get some insights, okay, from these issues. So when the paper discusses stable coins issued by digital platform, and they talk about, the unintended consequences from the data privacy regulations, right? So essentially they talk about, the role of network effects and the role of data. So the stable coins, with stronger network effects, right? So would probably encourage the platforms to subsidize users, which would reduce the reserves, right? And which also make so basically the volatility issue become more salient. So as a result, right? So they suggest should be heavily regulated in terms of capital requirements. The similar intuition is like the role of data. So we all know most of the digital platform actually, I think that they started as a, whether as e-commerce or social media, but essentially is the data acquisition probably is the key behind their business model. So essentially, the paper talk about hey, if the data acquisition incentive really drives the digital platform, right? Then this incentive would make the platform more aggressively to subsidize users. Then, of course, based on their models, that will increase the volatility of the stable coins, right? So that increase the systematic risk. So, and their implication for policy would be the data privacy regulation actually can help because it can decrease the platform's data acquisition incentive, thus to stabilize the stable coins, right? So that's, I think it's a very nice framework to help us to think about it. So let's look at it. I think the most updated example, right? So for the paper is also the mention about the Facebook, right? They are the liberal or the DM the project, right? So recently, right, the project was basically shut down by Facebook, of course, under the pressure of the regulatory agencies, right? So most recent, also talk about in the paper, right? So, and the most recent, the regulatory report is from the U.S. Regulatory agencies, and they issued a report on stablecoins, right? So, and in the report, copy here, there's a section on basically, really the systematic risk and the potential market power from the digital platforms. Okay, so let me zoom in a little bit. So essentially, in the report, okay, it basically suggests or it proposes that the combination of stablecoin issuer or wallet provider usually is now the digital platform, right, and the commercial firm could lead to a excessive concentration of economic power. Okay, so that's their rationale. So so essentially, this touches the key issue now for the digital economy and the regulation, right? So the first, when we talk about a digital economy, right? So usually, mainly, we mean, right? So the digital platform, how digital platform can bring some new issues to the economy and to the regulation. So the first question, we want to ask is, so what are the markets, where these digital platforms are operating, right? That's a very complicated issue, right? So, if you look at the paper, of course, the first market certainly is in the financial market, right? So it provides a new innovation in the traditional financial market. But then, essentially, all the digital platform, right? The tech companies started as the basically operating in the commercial or product market, like social media company, search company, or e-commerce. So most of the business are in the marketing or advertising business. But then fundamentally, actually, as the paper also talk about, all those digital platforms actually are, started as, or essentially, operating in the so-called production factor. In this situation is the data, right? The data becomes a new production factor. That's, the digital economy, why digital economy is new. So all these digital platforms are operating in the so-called data production factor market. So essentially, these digital platforms serves on the three markets. Okay, then but usually these three markets have a different regulatory or separate regulatory policies, right? Whether it's financial regulatory policy or in the product market, right? Competition policy and consumer protection and data privacy, right? Regulations. And quite often, and recently, worldwide, this industrial policy, okay, on digital transformation, right? Every country started to, jump on this trend. They essentially try to cultivate or develop the data production factor market. Okay, so that's the broader issues. Okay, and then I think the key behind this digital economy and the regulation macro issue is really the role of data, right? So based on actually from the paper actually it nicely illustrated the intuition, right? Can also generalize to this broad phenomenon, right? Essentially, the data acquisition incentives, right, of the digital platforms in the data production factor market, right, really drives and even distorts their market behavior in product or the like market competition and financial markets. But then we all know, the data market has some kind of unique features, right? The network effects and the increasing return of scale. So these type of features will tend to bring, some excessive market power, right, for the platforms, which might lead to, anti-competitive effects. That's quite often now the antitrust agencies are reviewing. And also in the paper, in this paper, right, so it shows can increase the systemic financial risk. So it suggests actually, in the broader theme, right, we can think about from the regulation perspective, right? So we need a coordination of different regulatory policies from, right, financial regulatory agencies, then competition and market authorities, right? And also consumer protection or the data privacy protection agencies, and also industrial policies, right? But essentially the data regulation is the key. So in other words, the traditional regulatory probably regime or framework will not work well in the digital economy era, because fundamentally data is the key, but the data is behind in three markets, and data is really the driver for the regulatory policies in all different policy arenas, right? So I think this is probably the broader insights we can get from this paper. And I think, my suggestion, like to polish a little bit of the paper, so now of course, the Facebook, the case is updated. So actually, in the paper, I really like how they model the data's effect using the capital A as the parameter. And then we can think about, of course, the data that the paper talk about, okay, it's because of maybe the data privacy, right? The regulation can have an effect on A, right? So the so-called data technology or efficiencies, but essentially can provide broader policy implication beyond privacy, right? So you can think about, the current regulatory debate. One of the heated debate is, should, the digital platform be allowed to go to, let's say, different market, right? So in China, the regulation on the platforms, right? They sometimes they impose strong restrictions on the digital platform. They go to different markets. So why usually the digital platform will go to different markets? Because they can collect more data or complementary data from user behavior in different industries, which can increase the data, let's say, insights, right? So I think, you know, for this paper, they can also provide insights, you know, not only about privacy, right? So, but also in this kind of broader regulation, I think policies. Okay, so that's probably my, you know, some kind of minor objections. But overall, I really like the paper. I think the paper can certainly really provide a great insights in the finance area, but also broader digital economy and the regulation area. That's probably my kind of take from the paper. Thank you for the authors providing this great, you know, paper for us. Yeah, thank you, Daniel.
I want to first of all, you know, of course, if to see if Simon, you want to directly respond to Yubo some of the comments, and meanwhile, I want to also open the floor to the rest of the audience, and just to see, you know, please, you know, if you have any questions, either raise your hands from our panelists, or, you know, just type whatever question you have in the chat box from our general audience.
Yeah, so I'd like to very quickly just answer to Yubo's points. I think the first very much thanks for this discussion, and we really appreciate that you also comment on this part, because I think it's like most discussions we have had at finance conferences from finance discussant, they were actually not much interested in this part, and we were a bit disappointed we never found someone who appreciated this part. But we also were kind of thinking along your lines, not as detailed obviously, that this is the clear incentives like for a digital platform to venture into this business. But we never really found, I mean, this line of thought was not really appreciated, also because like we don't have existing stablecoin designs. Yeah, they are not about collecting data. So currently like these Tether or anything, they have other issues, but they're far from collecting data in a systematic way. But I think the comments along these lines are very useful, and also to think about possibly further directions to spin this further. I think this is very useful, and also like we appreciate to get your view on that, like if coming from a different discipline.
I just want to follow up what Simon just said. I think your comments, your comments is very helpful in terms of helping us, you know, give us a big picture view in terms of where the paper fits, not just in the finance literature, but in the broad economics literature, because the way that we model the platform, it is a monopolistic platform, right?
Yes.
You can only derive this utility when you use this stablecoin, make these transactions only on this platform. And the monopoly power is being enhanced through data collection that happens in the last section of this paper that you focused on. And on top of that, the data collection incentive in turn destabilize the stablecoin, because to collect data, you need subsidy. Subsidy will drain the reserves, drain your liquidity, and then this will destabilize in the financial market. So I think your view in terms of connecting the product market, the computation monopoly issue, the financial market, financial stability issue, you know, whether stablecoin will debase, and then the issue of data privacy, these three together, I think it really helps us. I think it makes me, I need to discuss this with Simon, but it makes me feel more confident that we have more journals to submit now. As we broaden the scope. Thanks so much.
Yeah, okay, thank you. Yeah, I really enjoy it. Thank you.
I think there's a question, Michael Song, I guess.
Yeah, I guess, please, Michael.
Yeah, so this is interesting group of people, you know, from marketing, finance, and the econ, and even within econ, you know, I'm from macro side, and Daniel is from IO side. So I guess we will raise a lot of, we have raised, and we will raise some more, you know, out of the box questions. So just from macro perspective, you know, I think a lot of analysis kind of reminds me of, say, currency attack, you know, exchange models in the exchange rate literature. Although the focus is quite different, especially when it comes to this bimodal distribution. So I'm thinking about to what extent the model can be extended to, say, for instance, to take into account global game or high order bleed, so that, you know, you can allow people to speculate on which platform is going to run, and then we probably can generate smoother distribution. So this is kind of the typical approach in the currency attack literature kind of 2 decades ago. But I think model is already quite sophisticated. So I'm wondering if it can be extended along that way. So it's a technical question, but I would be interested to know.
No, so like that's a very good question, and from a technical perspective, we don't having a global games inside there like that requires some different information structure, and this is quite complicated in the current setting. We probably could do it, but like it would distract us from the things where we would like to focus. So we have type of runs like also micro-founded in a slight way, like in the newer version, slightly micro-founded, and then the people indeed run when the fundamentals in the exchange rate literature, they're typically called the fundamentals. In our case, it's the reserves or something like that fall below a critical threshold. Then there would be a run, which would be the similar outcome in the global games literature, just like more simple, with a more simple modeling. And the dynamics the model generates pretty much looks a bit like the run when we choose the right parameters. We have stability for a long time, and then suddenly when there's a negative shock, like to the fundamentals as you wish, then the price drops a lot and possibly to 0, and we get the same dynamics as we would get in a run, probably even empirically. Yes, that's how a run would look like. And the analogy to the currency, exchange rate literature and like how to defend a packet is quite strong, I would say. So like in this context, then the model would essentially say, if the central bank has high foreign exchange reserve, the inflation rate is low, and actually it maintains the peg, but then it switches to a floating regime when the foreign exchange reserves are depleted. And under these circumstances, interestingly, we have some variable called transaction fees, but that would be akin to inflation. And then inflation would also spike at the same time the currency breaks the peg. So this is quite an interesting analogy to draw.
Yeah, absolutely. And another question is, how do you think about, say, competition among different platforms? And say if you introduce some heterogeneity in, for instance, how much money that you can put onto the platform as collateral or reserves, whatever you want to think about it. And then, in the end, if you allow the heterogeneity, then in equilibrium, what kind of platforms will be able to survive? Is that kind of winner take all? Or, for a smaller, for those platforms with, less access to, for instance, external financing, or, they have less pocket to support, then would they actually, if you put that discussion into a kind of a more general setup as Yubo was describing, then relate this to the discussion about the combination or distinction between big tech and fintech companies. Then how this model is going to help us to understand the long-term equilibrium.
Oh, that's a very good question. So like, I think we asked, Ye said this and was also probably not explicitly mentioned in the presentation, but we consider essentially a monopolistic platform, consider the operation. So like you could say competition is relevant in as much it affects the convenience yield, that one could say in a very reduced form. But I think this is missing the bigger picture, not giving insights in how this competition unfolds, because currently we have like lots of these stablecoin initiatives. And I'm always wondering, like, how can they differentiate themselves? Like, why are there so many? Like, it should be winner takes it all outcome, which is like the common outcome for platforms if no regulator intervenes. But if you look a bit closer, that there can be some subtle differences. For instance, like one platform could collect data and is cheap for that. Like, what do users care? They care about stability, essentially. They care about the transaction fees you have to pay. And maybe they care about something else like privacy. And along these dimensions, I think there could be some differentiation, even so I think like the long-term outcome would be pretty much winner takes it all. Like, but there could be some differentiation. There could be like a stablecoin, less stable, cheaper to some extent, or like another one collects data, but compromises on the fees or such like that. There could be some differentiation, but through the lens of our model, we could only speculate and capture competition in reduced form? And I think it's interesting question to think about.
Yeah, so I want to come back to Michael's earlier question. There is this issue where global game can come into the picture. A very important issue, that is the reserves, whether it's common knowledge or not. So in our model, we do assume the level of reserves at the stablecoin issuer is common knowledge. In other words, we are assuming these stablecoin issuers, sorry, they are very honest. They properly disclose the level of reserves. The reality is certainly far from this. In reality, what the stablecoin users observe is at best a noisy signal of the reserves. And people do different kind of research, try to figure out even more. So we can easily think about an environment of heterogeneous information that is exactly a global game setting. So if we overlay a global game on the global game information structure on the reserve issue, we can potentially smooth out a lot of dynamics. This is, I think, is in line with what we are after. But when it comes to the sharp contrast between the stability region and the instability region, we think this by itself is interesting. I mean, even if we do not smooth out a lot of this dramatic action, this by itself is interesting because typically you need a RAM to generate this sharp action. But here we don't have a RAM. As a matter of fact, transiting from all these continuous states is smooth. But if you look at it, and we write a model in continuous time, but if you discretize the time and you look at what's going on, you can see very sharp changes. In other words, we are able to generate Rayleigh equilibrium features with a model that has a unique equilibrium. And what drives the underlying all this equilibrium action is the reserve level, is the reserve management. So we think that's very interesting. It's like, for example, Brudemeyer-Sannikov, the AER paper, right? They generate instability. I mean, in a unique equilibrium, they didn't prove it, but numerically it's pretty unique. But it doesn't feature any background, this traditional coordination failure-based instability or frigidity. It's a frigidity based on fire cell, based on this ergodic instability that is, the stationary distribution being bimodal. So that is where we come from. And the last comment I want to add to Michael's question is that if we just relabel our model, make little changes, we can make this model into a model of currency manipulation. Because in our model, the stablecoin issuer, it has in mind that they want to keep a peg because the users, they attach additional value on a peg. But they will debase if they run out of reserves. And the stablecoin issuer trade actively in the secondary market. So if we think about a central bank actively intervening in the foreign exchange market, and also have a peg in mind, but allow certain floating regime to come into the equilibrium when reserve is low, and this is exactly what we will need to model. So we are thinking about maybe write a companion paper and pitch this to the exchange rate literature. But the issue is, in the U.S., because everybody is very sensitive about currency manipulation, in spite of the fact that many central banks are actively trading in the foreign exchange market, if not all asset markets, right? But the policy circle is very touchy about this point, so it's a bit tough. But we are aware of many European scholars who write extensively on this topic still now. Yeah.
Let me add on one thing on this. Sorry, I think Yubo probably knows this better than me. The Central Bank of China clearly has been very interested in pushing RMB internationalization. And I think, this is probably the best framework I've seen so far to think about how, the central bank should be working on this thing.
So
Again, Yeah, absolutely. I mean, if the central bank intend to push the currency on an international stage, you probably want to, softly peg to a certain basket of currencies, but at the same time, you need to actively trade and managing your reserves, so that you can achieve some stability. Yeah, thank you so much for the comment. Maybe we should also think about broadening this framework to think about currency adoption. So I think Pierre-Olivier Greenschartz has a recent paper with another 6 authors on currency adoption that is based on the fact that you want to adopt a currency if your debt is already denominated in this currency, right? And then you want to invoice your revenue in this currency so that the inflow and outflow can match. But here we can provide an alternative mechanism that is transaction based, not balance sheet based. So yeah, if you have some soft peg, this can help the transaction value, which has network effect. Transaction value has network effect, which is different from the balance sheet channeling in Greenschart's paper. And then we can talk about this. I mean, in together with potential currency manipulation going on, in the secondary market.
Well, thank you very much. I really enjoyed the session, and also it made me very happy to listen to Yubo's discussion. When I first received the paper, I was thinking a lot about the exchange rate regime, the intervention. And can you hear me, by the way? I just want to make sure. Is my voice too soft or?
No, it's okay. Yeah.
Okay. I'm also worrying about having a cold, so my voice is kind of soft here. But let me try again. When I first received the paper, a lot in my mind was the exchange rate regime, currency substitutions, and the intervention. And also, like Michael said, there is a very intriguing multiple party dynamic game here going on. And that is about maintaining the stability of the exchange rates and so on and so forth. But then I thought more about it. I thought, look, so I think that it really is wonderful if we can get people like Yubo to come in to give us the overall picture about the platform and the use of it. And that's led to a question that I still find not answered, and I hope you can help me. Maybe my question really revealed my being ignorant in the subject. Why the platform has to issue a stable coin? Why does it have to? Why? I mean, if you talk about privacy and all this kind of thing, I can use RMB or whatever. It still is. I just don't understand. Why do we need?
Oh, so like the last part was like vanished. Why do we need stablecoins? Yes. Yeah, so like the short answer is like there's like some demand within this decentralized finance sector because you need some digital dollar. Essentially, you need some digital dollar there. So you have to bring essentially the dollar on the blockchain, and that's then and then you have a stable coin. Yeah, so like fundamentally you wouldn't need it if you could like transact with the dollar within decentralized finance or this ecosystem, but you cannot. So that's the problem.
So fundamentally, it's basically you want to bypass the government.
That's another
reason. If you want to
yeah.
bypass the government, why do you need the reserves?
Yeah, so like, I mean, there's from a stablecoin issuers perspective, you can make some easy bucks essentially with this senior rush by minting essentially money. And if everyone believes this is a dollar, you even can make money without having some reserves. Otherwise, yeah, so like there could be some like, I mean, that's a general question why people like value these cryptocurrencies to some extent. Some people might say like, okay, we have like, some decentralized payment system bypassing the government. Someone might, they might appreciate this for certain activities. So, I mean, that's why Bitcoin emerged in the first place, I guess. And similar issues apply to stable coins, yeah. I mean, that's some, yeah.
You see, if my intention is to really expand the platform to acquire the very valuable data so that
are we talking about
my own territory, I don't need to do that. I
I
mean,
see.
and also, like, why do you want people who participate in my platform for the purpose of evading the government?
Oh, see, you mentioned, okay, we're referring here to the platforms. Yeah, so then it's platform case. Okay, so that's sorry, like I was like more in this generic stable coins and like, but especially for these platforms, yeah, so like that's a good question. I mean, we had like, you know this probably, you're more aware of these details, but I mean, Alipay, for instance, was exactly that. Like you had a payment system, but like this was not a stable coin. But essentially in all other aspects, it's something similar, I would say. You have something, I mean, you could fundamentally get some senior rush out of this. By minting.
So I guess the key difference between stablecoin and Alipay is that you can think about Alipay almost as money market fund shares as being used as means of payment. I mean, in combination with the Yubo, that is the money market product provided by Alibaba. It's almost like money, but with some interest rate. So here, it's the stablecoin issuer. They have a capital structure. They have equity, what they call the governance tokens, and they also have debt. The debt, the quote-unquote debt, is a stable coin, and the debt can actually have some debasement. You can think about this as related to COCO, right? Convertible debt, except that the debasement, that is the state contingency, comes in under the discretion of the issuer, not with some pre-specified trigger. But I think a very important point that Bernard brings about is that so why do we need stability with respect to a currency in general? So I guess if the user base deals with a certain currency more often, for example through invoicing, then this particular clientele would prefer stability with respect to this currency, because stability means information insensitivity, and information insensitivity means less information asymmetry and a more liquid secondary market, if we think about Gorton Fibonacci, for example, right? So, but the question then comes, well, what if a platform wants to be global? Should I peg to US dollar, or should I peg to a basket of international currencies? But if I peg to a basket of international currencies, I will be unstable with respect to any of them, right? So I'll be unstable with respect to US dollar, I'll be unstable with respect to Japanese yen. And so in the end, my portfolio choice when it comes to constructing basket also becomes a question. And this portfolio choice will be dictated by the clientele. So yeah, these are all open questions that I think we can explore further.
Yeah, let me probably try to answer Bernard's question. So I think from the platform perspective, I think there's certainly Alipay. So that's the stablecoin, as you mentioned. The payment is very different from the cryptocurrency, from the digital platforms. Let's say strategy or demand perspective. As we all know, Alipay is essentially started as the resolving mechanism instead of really the financial payment. Of course, then it goes the financial payment or the equity market essentially become a byproduct. So I think I agree with Ye that in a sense is if the digital platform with they stay in the domestic market, so I think Bernard, I don't think there is so basically the stablecoin is not, I think, an essential function, should not be the essential function for any digital platform. I think and of course, if they want to expand and make more profit from this, that's actually the regulatory, the issues, right? Whether it should be banned or not, right? So, but certainly it's not the essential function. But if they started to go abroad, like for instance, a lot of the e-commerce platforms start to go abroad, I'm not saying like it is essential. So as you mentioned, probably this type of the currency fluctuations and because they have the probably like 2 billion users, right? So then they get started to kind of this type of stable coin does have very important basically functions for the digital platforms, right? So I think that's so that's probably this type of issues become more important. But certainly the stable coin itself, I don't think I agree with Bernard, itself is not a data collection functions essentially, right? So
can I actually interrupt with because we have a question in the chat box, and then I just want to leave some time for the audience. The question was the audience is, he was asking if seems like it depends on the platform's reputation. He said if the platform has high reputation, then does that really need any reserves? So like a free banking system. And he's asking, if the building, seems like building the value of reputation is a very important incentive for the platform to keep stable value and a guarantee value. That was the question. I don't know if Simon, you have any thoughts about it?
No, so like that's a very good point. Yeah, so like you could think of this as substitutes, especially like if you have a large platform with high reputation, then this platform probably also has like access to reserves if the stablecoin business is a small part of their business and can easily inject money. So you would have like a low cost of funds in that sense. Another thing is like, of course, like if you're a stablecoin platform standalone, you would like to build reputation, and then initially you need more reserves, as I think was mentioned in this question. I completely agree with that. Like, I would think of these reserves and reputation as substitutes, I would say.
Okay, great, thanks. Yeah, I guess we already have a lot of questions pretty late, so I don't want to hold everyone up here. So let's just thank our speakers and discussants for this great session, and I also want to thank all the active participation by our panelists and the audience. Again, thanks so much, Simon and Ye. It's really interesting work, and I look forward to seeing a lot more from you on this very exciting topic.
Thank you so much, Daniel, for inviting us. Bye.
Thank you, everyone. Really, I want to thank Daniel, the chair, the presenters, the authors, and Yubo and Michael, all the questions. This has been a really very, very stimulating session. I learned a lot, and I look forward to seeing you all again on April 6th, which is again platform impact of digital platforms on entrepreneurship and industrialization, evidence for e-commerce expansions in China. And Will Chong of Cornell will present the paper, and Greg Buchek of Stanford will be the discussion. Again, thank you, everybody. I really appreciate what you've done. Thank you. I learned a lot from you.
Thank you for organizing.
Thank you.